Welcome back to the deep dive. It is Tuesday, February 24, 2026, and looking at the charts this morning, Bitcoin slipping below that $63,000 support zone is,
It's pretty ugly.
yeah, ugly is definitely the word. But look, we're not here to just doom scroll with you today. We've pulled together some fresh market reports, institutional 13F filings, and new legislative bills to really get a handle on this.
Right. Our mission today is to figure out why this flush is actually happening. And spoiler, it is not the tech.
Exactly.
Uh,
We want to show you the counterintuitive moves the smart money's making while retail investors are frankly panicking.
because the market is
Yeah.
definitely in a state of extreme fear right now, total capitulation. But the reports make it clear this is a macro story.
Yeah, it's this toxic cocktail hitting the markets. We're talking about the new 15% global import tariff that got invoked.
Yes. And what is really spooking people is the statute used, Section 122 of the Trade Act of 1974.
Right, which is not your standard trade dispute lever.
No, it's not. Section 122 is specifically for balance of payments emergencies. The administration is essentially signaling a fiscal crisis.
And that screams inflation to the market. If import costs suddenly jump 15% overnight, the Federal Reserve is completely handcuffed.
Exactly. They can't cut interest rates if inflation is spiking again, so the liquidity tap stays off.
Which gives us this massive risk-off retreat. Investors are just fleeing to the U.S. dollar. I mean, we are looking at realized losses of over $2.3 billion in just 1 week.
People are definitely running for cover. But this is where it gets interesting, because while retail is eating those losses, the institutional filings tell a totally different story.
Yeah, let's talk about Harvard Management Company. They manage that massive $50 billion endowment.
Right.
I was looking at their latest filing, and they didn't exit the sector during this crash. They recalibrated. They trimmed their Bitcoin ETF position IBIT by about 21%.
But then they started a massive new position in the Ethereum ETF, ETHA.
Yeah. It's not a sell-off, it's a swap.
It is a classic relative value play. I mean, Bitcoin is down 47% from its highs, but Ethereum is down 61%. It's just statistically cheaper right now.
But the real kicker for an endowment like Harvard is the yield.
Right,
Yeah.
precisely. The staking yield. Unlike Bitcoin, Ethereum actually functions more like a dividend stock.
Because Harvard has operating costs to cover. So buying a yield-bearing asset while it's sitting in the discount bin, that is just textbook endowment strategy.
They're buying the cash flow. And while the institutions are quietly bargain hunting, the actual infrastructure of the market is getting a huge upgrade.
Oh, the Yahoo Finance and Coinbase integration.
Yes. For years, you went to Yahoo Finance to research, and then you had to go to a totally different app to actually trade.
But now you can execute trades on Coinbase directly from Yahoo Finance with one click. It merges the research and the action seamlessly.
The friction is just gone. And that matters when sentiment flips back to bullish.
Speaking of friction disappearing, the SEC just did something huge. They granted WisdomTree exemptive relief for a tokenized mutual fund.
This is such an aha moment for the space. Traditional mutual funds price once a day at market closes.
Right, if you need liquidity at noon, you just have to wait. But this tokenized version allows for atomic settlement. You can trade it 24/7.
It really proves the regulator is getting comfortable with blockchain infrastructure handling registered securities. The prices might be dropping, but the technology is being validated.
It feels like the U.S. is finally reaching operational maturity. We have the Genius Act moving to regulate stablecoins, the Clarity Act defining securities versus commodities.
And then you have the state-level activity, which is fascinating.
Yes, Michigan. So, reporting strictly on the text of the bill they just introduced, it would allow state employees to receive their wages in Bitcoin.
But the really interesting part is the ban.
Yeah, the bill explicitly prohibits state-controlled digital currencies, or CBDCs.
It is a total jurisdiction battle. The federal government is studying digital dollars, while states are drafting laws to block them and embrace Bitcoin.
So pulling this all together for you, the price action is ugly right now because of this emergency tariff and inflation fears.
But the infrastructure is permanent.
Exactly. Harvard is hunting for yield, laws are being written, and tokenization is moving forward. This crash is a stress test, not a death knell.
The rails are being laid down regardless of the current price.
Which leaves us with a final thought for you to chew on. If tokenization allows traditional mutual funds to trade 24/7 with atomic settlement, are we approaching a world where the very concept of a market close becomes obsolete for all assets?
Not just crypto, but everything.
Exactly. Thanks for taking this deep dive with us. We will see you next time.